Hello, everybody. Thank you so much for joining and taking time out of your day to join us, hopefully over some lunch. Thank you again for joining us for Financial Foundations with Canvas Credit Union. This program is brought to you by the CSU Alumni Association and is sponsored by our friends over at Canvas. My name is Sophie, and I work with the CSU Alumni Association, and I'm also a proud alumna, so super excited to be here and excited to learn from our guest presenter, Olivia, today together. Before I officially kick it off, I just want to go over some quick housekeeping. We're running this event via two platforms at the same time, so via StreamYard as well as YouTube. And we'd love for you to ask questions or comment on the material as we go. But if you have a question or comment, go ahead and use the chat feature or the comments feature, depending on whichever platform you're looking on. It all comes to the same place for us and we'll be able to see it. But if you have an issue for any reason with posting your question, feel free to email me and I can post it for you. I'm going to go ahead and put my email up here. So I'll drop this in the comments as well as we go on. But if you have any issues with posting, feel free to email me and I'll make sure that that gets put in front of Olivia. Um, Last but certainly not least, I'd like to do just two thank yous real quick. First is a thank you to our CSU Alumni Association members who are tuning in today. Your support through membership makes connective and educational programs like this possible, and this measure of RAM pride is so strong, so thank you so much. And secondly, a thank you to Canvas Credit Union, not only for presenting today, but for sponsoring the alumni career programs as a whole, and for serving as really great resources for RAMs both on campus and around the world. Now I'm going to hand things off to Olivia to get us started.
Yeah, thank you, Sophie. I'm Olivia Oriana. I work over at Canvas in our community involvement department. I'm super excited to be here with you guys today and grateful for the CSU partnership with financial education. Today, we are going to learn about financial foundations. If you guys have questions throughout the presentation, please pop those into chat so that we can get those answered for you. And I love interactive presentations. I will have some questions for you, but feel free to use the chat if you're comfortable doing so. Today we're going to, and then Sophie, go ahead and do the next one. As we explore financial foundations today, we're going to look at money from several perspectives. We're going to talk about how you can use money right now, which is most likely for your spending. We'll think about why you want to approach money with an eye to the future by savings. Sometimes there isn't enough money in your life to accomplish what you want, so we're going to cover the basics of borrowing money, how to do it wisely, and some dangers to watch for. And then we're going to spend some time on something that many people struggle with, and that's a future view for your finances. So planning way out there. Slide. We're going to start the conversation today about financial foundations with a look at our spending. Slide. There's a lot of people that we find that are confused about the difference between a bank and a credit union. So we're going to start with the difference between the two. And the why. Why would you use a bank or a credit union? Well, one big reason is the convenience. You get paid through your direct deposit, or you need to deposit a check, you need to pay your bills, you need to pay your loans. They are both insured, so we're both protected. If you have money at a bank, you're insured by a federal fund called the FDIC. At the credit union, it's the same. It's just the NCUA. So you're insured through both for up to $250,000 per account. A lot of people that hear credit union, they think that it's related to a credit card or credit, but we essentially are a bank. So credit unions and banks do the same thing. We provide the same services and products. So we both have savings accounts. We both offer checking accounts. We have the same type of loans. We offer financial advisors. We even make our money the same way. The big difference between the two is who owns them. So banks are owned by stockholders and investors. So when they make money, they have to pay I like to say the big guys up top, right? The investors and stockholders. If you belong to a credit union, we are member owned. So if any of you currently bank at a credit union, whether that's Canvas or Ent or Credit Union of Colorado, you're technically part owner of that credit union. And what's really cool about credit unions, because our profits go to owners, that gets poured back into our members in the form of better rates. So when you guys need a auto loan in the future, maybe it's a personal loan, a credit card, we're typically going to offer you a better interest rate on your loans. And why that matters, you have better monthly payments and you pay less interest for the life of the loan. Now, when we're thinking about savings, we're also going to pay you better interest rates on your savings accounts. A cool thing about credit unions that not a lot of people know is that we're cooperative. So all credit unions work together. And what I find just teaching financial education in the community, or when I worked in the branches, is a lot of people bank at the big banks. And when I say big banks, that's like Chase, Wells Fargo, US Bank. A lot of people like those guys because of the availability of locations, right? If I live in Colorado and I go on vacation in any state in the United States, they're going to have a Chase, they're going to have a Wells Fargo. Now, if I bank at Canvas, let's say, and I go outside of Colorado, I'm not going to find another Canvas. But the really cool thing is that all the credit unions work together. So you can actually access your credit union account at different credit unions nationwide. And to take it even one step further is all credit union ATMs are free if you belong to a credit union. So if I bank at Chase and I am driving down the road, I see a Wells Fargo ATM, Chase is going to charge me a fee and Wells Fargo is going to charge me a fee. If I bank at Canvas and I am out of state or driving down the road and I see another credit union, all ATMs are free. So there's lots and lots of access that makes credit unions really cool. Slide. Now, before I get into budgeting, if you're comfortable doing so, I would love for you to put into chat if you currently budget and if you are budgeting, what system do you use? So how do you budget? If there's any online templates that you use or apps that you love, if you could pop those into chat. When you're talking to financial experts, they're going to suggest two things to make your financial life be successful. One is to set money aside in savings, and we're going to talk about that in the next section. And the other is to use a budget. I'll be honest with you, we're not as concerned about people setting up a budget as long as you're tracking your spending. A big challenge we see when people come to us with financial problems, they don't know what's going on with their account, right? They don't know where their money's going. They're not sure what's coming in each month, what's going out each month. They just know that they don't like how it feels when they're living paycheck to paycheck, or maybe they weren't paying attention and tracking their transactions, so they went negative. It's not complicated about budgeting. You just have to make sure you're tracking your spending. And the goal of this, right, is to achieve the bigger financial picture of what you're trying to achieve in your life. You start by finding a method, and that's, as I asked you guys, what tools you use to budget. Maybe it's an app on your phone. If you are an Excel spreadsheet lover, I'm not a lover of Excel, great tool to create your budget. You can do like me, I do old-fashioned notebook. I have 2 sticky notes. I have the first check of the month, the second check of the month, and what needs to get paid out of each check. That's just what works for me. If you bank at pretty much any financial institution nowadays, categorizes your spending for you. So it kind of already breaks it into categories, which is really cool. Budgeting is going to take a little bit of discipline and require consistency, but it's really easy. Again, you're just entering your income and expenses, but the benefits are going to be outstanding. Now, you'll know what your money is doing. If you like what it's doing, great. You don't need to make much changes. If you don't like what you see, you can make changes. The trick is that you can't improve things if you don't know what's going on. When you look at your numbers, whether you're positive or negative, you can make a plan for your income and spending, and that's what the budget is. We know plans don't always work out. You might have to adjust things as you go. And you want to also budget and spend money based on your values. We all make different incomes. We all have values, different priorities. So it's not a one size fits all. I always joke with my boss, he likes to eat out a lot. So in his budget, he's going to spend a little bit more on eating out, where I value travel and entertainment. So I'm going to spend a little bit more on those categories. It doesn't matter what categories are important to you. It's just making sure you have money set aside in your budget for those things. And the biggest thing, again, is just tracking your spending. If you find that you don't have enough money to do the things that you want to, but you realize you're spending too much on eating out, or maybe it's that you have too many streaming services, this will reveal your spending for you and where you need to make changes. Go ahead and do the next one. Now, just like we all have our own personalities, some of you may be outgoing or private. Maybe you're adventure seekers, or you err on the side of caution more. You're nurturing, you're independent, protectful. Maybe you have a glass half full view. We also have different ways we feel about money. Some of us may be more inclined to spend than to save. We may use money to feel secure, or maybe money makes us feel more powerful. It's all about finding balance. And if you have not taken a money personality quiz before, I highly recommend it. There's lots of quizzes online that can be very fun to take. They also can be revealing about how we feel about money. And they also give good tips on how to not deprive yourself. For example, if you're an aggressive saver, maybe you are fearful of spending money, so you deprive yourself of the fun in life and you're too aggressively saving. So it teaches you some tips how to change that. Maybe you're a big spender. Maybe you're giving too much to family and friends that it's getting to a point where you're being taken advantage of. So there's some weaknesses to watch for in your money personalities as well. But again, I encourage you, just Google when you have free time, money personalities. It's really fun to know your personality. Go ahead and do next. So far, we've talked about some really basic financial ideas, using your accounts, tracking your spending, budgeting, a little intro to your money personality. We're going to talk about another important concept, and that's having money set aside for savings. Go ahead and do next. And I'll ask for chat one more time. Why do we save our money? What are some reasons that you may have a savings account? Savings account are for both challenges and emergencies. It's good and exciting things. The reason that experts suggest having a savings is because we know there's going to be a financial challenge in life. You can have a great credit score, you can have a great income, but life is always going to happen as adults. You don't know what, and you don't know when it will come, but as you know, as adults, they come sometimes. Those charges and unexpected expenses come in multiples. So the best way to help prepare for those unexpected expenses is to save, so that you don't have to use those high interest credit cards. And remember, savings can be for the fun things too. You can enjoy travel more if you've saved for it. You can enjoy a new car more if you've planned for it financially. We like to talk about a financial term called opportunity cost. And that means that you can only spend money once. The goal is to figure out what's the best way to spend what you have. So it may mean making choices like, if I eat out lunch every day for a month, that is at least $300. Maybe if I only ate out half the time, I'd have enough that I could buy that concert ticket. So what's the best use of my money? Well, that depends on you and how you feel about things. Another example is if you spend $5 a day. That's easily how much many of us spend on a coffee each day. Maybe it's a breakfast burrito, an energy drink, whatever it is that you spend a little bit of money on every day. $5 a day equals more than $1,800 in a year. So you have to ask yourself, is a coffee every day worth $1,800? Would you rather have a new phone than having coffee every day? Now, looking ahead, if we look at how much that comes to after 5 years, if you have a coffee every day or $5 burrito every day for 5 years, that's over $9,000. Maybe you're the person who loves travel, you need a new car, down payment. What's the best use of your money? It's so easy to say it's just a few dollars. We often hear people say that they can't afford things, but maybe it's because you're not setting the money aside in savings that you can do those things that you want to do. If it's just a few dollars a day, remember that does add up very quickly. And remember, if you're tracking your money while you're budgeting, that you're going to see some of this and you can adjust the savings and spending. If you're going to have a savings, we want to take a look at some different type of accounts you can put your money in. And remember, when your savings, we pay you an interest rate, or all financial institutions pay you an interest rate. So the goal is to earn as much as you can with the money that you put into your savings account. So just to go over how a few accounts work, those basic savings accounts have low minimum deposits. Some have no minimum deposits, but they're going to pay you a really little interest rate. The advantage is that they're liquid. You can deposit and withdraw as much as you would like. Now you have money market accounts. Those are going to pay you more than the basic savings. Those are also liquid, but require a minimum. So money markets typically start at $1,000 minimum. There's a $10,000 minimum, and then there's jumbo money markets that require a much higher balance. And it's liquid beyond that minimum requirement. Now, where you're really going to earn the most for your money is high yield savings accounts and those CDs or certificate of deposits. The certificate of deposits are you committing to locking your money up for a certain term. So you can find CDs typically for a 6-month term all the way to 60. Historically, the longer you put your money in a CD, so if I do a 60-month CD, I'm probably going to get paid more than putting my money into a 12-month CD. But depending on promotions and the market, there sometimes are really short length CDs that you can find at really high interest rates. Now, the downside to a CD is, let's say an emergency happens and you locked all your money into a CD, you're going to get a penalty to withdraw your own money. So I always like to tell people, if you have a 5 or 10-year goal, for example, to buy a house and you're just letting that money rack up, it's probably generally safe, right, to put your money in a CD and let it grow that high interest rate. If you plan on buying a house next year, probably not a safe idea to put your money in a 24-month CD. Now, the high yield savings accounts, I love, love, love these. They have high interest rates. They typically don't have a minimum deposit required, and they're completely liquid. So again, the goal is to make sure that you're earning the most for your money. And just to kind of put that into perspective, we have an example here on the next slide. So, there we go. Thank you. In this example, we'll talk about if you have 500 on deposit for 5 years. Okay. So if you have $500 in a big bank, like I said, they're going to pay you a really little amount, 0.0%. You're going to earn 25 cents over that 5-year span. I don't even know if in this economy you can buy a gumball from a gumball machine for 25 cents now, right? Not astronomical earnings over a 5-year period. Now, let's say you find a regional bank, a local bank. They're going to pay you a little bit more, but 50 cents earning, still not worth it. If you belong to a credit union, you know that you have to have a basic savings account. That's what your membership buy-in is, essentially, whether or not you use it. If that is the only savings you're using, we're going to pay 10 times more than those big guys, 0.1%. But again, $2.51 over a 5-year period. That's really nothing. Now, let's say you find a high yield savings at 5%, you're going to earn $141 over that 5-year period. And I always like to point out $500 is relatively a low amount of money in a savings account. So if you have a bigger savings, that earning is going to be bigger. But just to show the drastic difference from that 0.01% to the 5%, I encourage, if any of you don't know your current interest rates, to check on your online banking apps, ask your local financial institutions to help you. A lot of adults we find don't know that they can even earn money on their savings account. So they're in those really low interest rate accounts. So to make sure you're getting something for your money while it's sitting there, make sure you have those higher interest rates. Go ahead and do the next one. Thank you. So far, we've talked about setting money aside in savings. Now we're going to talk about ways to cover money so you can cover fun or a problem. Just some of our best tips, because we know everybody has to spend money. So how can we save money when you have to spend it? Do you have a favorite entertainment spot? Maybe it's a rec center, a museum, restaurant, coffee shop chain. Chances are they have some sort of membership or reward program that you can earn a lot of money. Reward programs with grocery stores not only save you money on your food, but you can also have fuel discounts. I love, love, love the Kroger or King Soopers app. I not only earn points throughout the week, but if I shop on Fridays, there's a coupon, a digital coupon that I get 4 times the fuel points. So by the end of the month, I usually could go to the gas station at King Soopers and get $1 off 3 times, which is huge right now with rising gas costs. Libraries, if any of you check out local libraries have more than just books to check out. They have free passes to museums and parks. You can actually check things out like telescopes, sewing machines, GoPros, karaoke machines. Some libraries, like the one in my area in Commerce City, we have a studio in our Anythink library. I can do 3D printing for free. I can do make banners, make t-shirts. There's so many cool things that libraries offer nowadays, as well as the library in my local area. I can print up to 50 pages per day for free. So lots and lots of ways to save money by utilizing your libraries. Another classic way to save money on groceries is to plan your menus. If you're anything like me, I'm an impulse buyer when it comes to grocery shopping. So I used to go to the store without a plan and I would decide my meals as I went. And I would find that every single week I went grocery shopping, I was going over my allotted grocery budget. So I started making a list, and that really helped cut down on that excess spending. And I've actually, in the last 6 months, have taken that even further, started shopping online, and I absolutely love it. The reason I love the online shopping and the pickup, not only does it save me a significant amount of time grocery shopping, I can actually see the cost of what I'm spending on groceries as I go. So there's no surprise at the checkout lane. If I am over my grocery budget, I can adjust things before I hit order. So that's just a way that I take a little bit further. Now, if you need to rent a bike, maybe you want to go on a tour on vacation, eat out at a new restaurant, there's probably a coupon available. So make sure you're still looking for coupons. If you start tracking your spending, you'll likely realize how expensive it is to eat out. It's one of the bigger categories in people's budget that they spend money on. So we have a couple tips when it comes to eating out. Try going out for breakfast and lunch instead of dinner because those often cost less. Try to drink water instead of a costly beverage. Plan to take half of your meal home. And of course, you can cut back on how often you go out. Probably not a popular idea, but anytime you can slow down your spending, you'll probably save money. And our biggest tip is slowing down the spending. So a few ways to do this. My favorite one is the 24-hour rule. So this really applies to online shopping. Is if you see something you like, you can place it in your cart, wait 24 hours to buy it. This gives you time to really think about the purchase. Do I need this? Can I borrow this? Does this fit in my budget right now? Do I have a plan to pay this off if I have to use a credit card? Chances are you've assessed the purchase, and the next day, if it's not something that you still want, you'll have had time to rationalize it, and it does help decrease spending. Another one is not storing your card number on your favorite site. I like to use the Amazon example because I feel like everybody uses Amazon. If I'm scrolling on my phone and I see something that I like and it's on Amazon, right? I can put that in my cart and have it shipped to my house in less than 60 seconds. There's no thought process about it. It's an easy way for me to impulse purchase. My address is saved, my card number is saved. They make it really, really convenient. And that's how a lot of people get into trouble. So if you can, try not saving that stuff. Believe it or not, having that extra step and less convenience slows down your spending as well. So just a few ways to slow down your spending. Go ahead and hit the next one. Now, regardless of how smart you are with your savings or spending, there's probably going to be a time in your life where you need a loan because you don't have enough for what you need. So those are, big ticket items like a car, maybe it's a house. So we're going to take a look at some basics about loan and borrowing money. Slide. So why do we get loans? The biggest reason we get loans is because we need something and don't have the full purchase price right now. We get loans for something we want, like vacation sometimes, or other material things, but a smart financial decision is going to be to save up for your wants and keep loans for needs. Now, you might hear some people say, I stay away from loans. Loans are bad. Most of us don't have $400,000 or $500,000, right, to just go and purchase a house outright. So they can work to our advantage because if we were paying rent, let's say, and you want to purchase a home, that would take a lifetime, right, to save up that extra money. So it does allow us to get those things now. Now, the downside to the loans, it's going to make your costs increase, right? When you pay back a loan, you don't just pay what you borrow, you pay the interest as well. There's two main kinds of loans. There's installment loans and revolving loans. Installment loans means you borrow a lump sum of money and you pay it back in equal payments over time. So a car loan, for example, you borrow $25,000, you pay it back in equal monthly payments for 5 years. The other kind of loan is revolving, and that's how credit cards work. So instead of having a start and finish time, the loan is essentially open forever. It has a maximum amount you can borrow, which is your limit. And then the amount that your monthly payment is depends on how much you've borrowed that month. So that payment can change. If you have a $2,000 limit, let's say, and a $1,500 balance, your payment's going to be higher than if you just have a $100 balance on that card. And it revolves and changes over time depending on the use of your card. A few other installment loans are home loans, student loans, and then other revolving loans are your line of credit. So if you have overdraft attached to your checking account, if you have a home equity line of credit, those are also revolving loans as well. Go ahead and hit the next one. So this is my favorite example. It really shows you the cost of bad credit. So this is an example in two different scenarios that need to purchase a vehicle loan. So we know that your credit score is a big factor that goes into, as I mentioned at the beginning, how much your payment is and how much interest you pay for the life of the loan. So in this scenario, person A and person B are both in the market for a brand new vehicle. Person A has a 620 credit score. So they may have had trouble with payment history in the past. Maybe they have some maxed out credit cards. They have a 620 credit score. The 720, they pay off their credit card every month, so their balances are at zero and they have great payment history. They go to the same dealership and buy the same exact car. It's a $30,000 vehicle. They do a standard term, which is the 60 months or 5 years. The person with 620 has an 18% interest rate. The person with 720 has a 7% interest rate. So you can see in the difference of the monthly payment alone is about $165 a month difference just in the payment. But where the math gets really, really crazy. So let's say person A did not refinance their vehicle throughout that whole 5 years, and they made that $761 payment for the whole term. By the end, when that vehicle is paid off, they'll have spent a little under $46,000 for a $30,000 vehicle. That's a lot of interest. Now you can see person B, they paid a little under $6,000 in interest, but the difference between person A and person B for the same exact vehicle was $10,000 in interest that person A had to pay more than person B. So when we're thinking about these numbers long term, these really matter. I just seen something interesting on the news a few weeks ago, and they said the average cost for a new vehicle right now is $50,000. So that's the average cost of a new vehicle, right? And this example is on 30,000. So that is even more interest, higher payments if you have that lower credit score. And then when we're thinking about a super big loan, like a home loan, right? That credit score really, really matters. So the last thing I'll plug in on this side is you are never stuck with your original interest rate. Let's say you were this person A, you had the 620 score, you needed transportation to get to work. Now you've worked on your credit for 6 months, maybe it's a year. You can always refinance. You can refinance. What that does is they'll reassess your credit. And if your credit has increased, that interest rate's going to drop. And if that interest rate drops, right, your payment's going to get lowered and you'll pay less interest for the remainder of the loan. A lot of people think that you can only refinance mortgages. You can refinance any type of loan. So these are things that you want to assess throughout your life to make sure that you have the lowest interest rate in accordance to your credit score. Go ahead and do the next one. Now, if your credit score is so important, you'll likely need a loan at some point. So there's a few ways you can prepare to do that. So if anyone has not yet built credit or you're needing to rebuild credit, there's a few ways to do that. One is having a cosigner. If any of you do have kids that are of high school age or maybe they are in college themselves and graduating and into adulthood and you co-sign them on a loan, it could be a great tool for you if you have a responsible person in your life that can help you rebuild your credit, or you can help build someone else's. But I do want to note, a lot of people get confused with co-signing. If you are a co-signer on a loan, you are a joint. So that means you both are 50% responsible for that loan. So I see this a lot where dad co-signs son for a vehicle and son starts missing payments. Well, guess what? Unfortunately, dad's credit can be affected. So you really want to make sure that both parties are responsible in this situation, but it can be a great tool for building and rebuilding credit. Now, the next one is an overdraft line of credit. So this is typically one of the only loans that you can get without having any credit. So if you are somebody who is just starting with credit, this loan is attached to your checking account. So in the event you were to go negative, it would pull money from your overdraft loan and put it in your checking so you don't get those nasty overdraft fees. Now, the cool thing about this loan is you don't actually need to go negative in order for it to build credit. So it could be a great tool. And then the last way is those secured cards. So a secured credit card is you go to your financial institution, typically a $500 minimum. We put that in a CD, so that account that locks your money up. So it's locked in a savings account, and we turn around and give you a credit card with the $500 balance. That typically takes about 6 months to start building your credit. A lot of people get confused with those secured cards because they think, well, it's my money. I gave my money up. Yes, you did secure with your money, but it is a real credit card. So you have to make your on-time payments. You have to keep your credit utilization low. But again, another great tool. Now, just some reminder tips when it comes to borrowing is you really want to look at your wants versus your needs. Right? You don't need that fancy $300 pair of sneakers that's brand new if that's not in your budget. Putting a bunch of concert tickets or vacations. I've been there in my 20s, gotten a lot of trouble, but you really want to have a plan for those wants. Keep the loans for need based, and even with the needs, don't take it too far, right? We need transportation, but do you need an $80,000 F-350? Probably not a great financial decision in your 20s, right? So just really assessing those type of things. And then a great tip for paying loans is anytime you can pay ahead above the minimum, that's going to help you out. A lot of people don't think that those really make a difference. Even if it's just $10 on a credit card, it doesn't sound like it's going to make a difference, but it will literally cut off months and interest on the back end. And it's really, really, this is for all loans, it's impactful, but for those credit cards, it's really, really impactful. The average interest rate right now for credit cards is around 21%. So that's really, really high. So anytime you can pay above those minimums, right, and start knocking down more of that principal, that balance, those will really, really help you pay down that debt. Go ahead and do the next one. Now, the last part of financial foundations we're going to talk about is that long range planning. For some of you, depending on your age, it might be really challenging to consider this because it might seem so far away. Maybe if you're freshly graduated for college, retirement, or long-term planning seems unimaginable, but we're going to talk about why it's important on a planning short-term and long-term. So go ahead and do the next one. So we're going to talk about financial goals. We know that talk alone does not get you to where you need to go. These are some common goals that we hear from people, but goals need a plan in order to succeed. So some common things we hear is, I want to build an emergency savings, right? They want to build up that savings. Maybe they want $10,000 in an emergency savings. I want to pay down my debt. I don't want any more credit card debt. I want to pay off my auto loan. I want to purchase a home. I'd love to travel the world. Maybe it's that I want a career change, or I want to make sure I can retire early. Maybe it's that you want to start a business. Again, just saying these things are not going to get you to that goal. So if you have a financial goal, we really challenge that you write it down, make it a SMART goal. It needs to be specific. It needs to be attainable. It needs to have a time frame. You have to have a way to measure it. So if I have a bunch of debt and I'm going to say, well, I just want to pay down debt. Well, what does that mean? Make it, I want to pay down my credit card that has a $2,000 balance by the end of next year, and I'm going to do this by putting an extra $50 a month towards that payment. So that makes it much more attainable. Also, don't be too overly ambitious with goals. Take it in bite-sized pieces. If you are somebody who has not started savings yet, or maybe you have a low amount in savings, saying that I want to save up $10,000 in a year is not realistic for most of us, right? So make it an attainable goal. I want to save $1,000 this year. Once you get to the 1,000, I'd like to save up to 5,000 and build from those. And then make sure you celebrate your successes along the way. As you can see here, we love this quote on the screen. He who fails to plan is planning to fail. So make sure you really have a solid plan to reach those financial goals. Go ahead and do the next one. A lot of financial goals revolve plans and can be big, involving lots of time and money, or they can be much simpler and very easy to adopt. So we're just going to go over a few ways that you can use planning to your financial advantage. If you know you'll be spending money on the holiday season or vacation, maybe you need to replace a vehicle, you need to plan to set aside money ahead of time. So one thing in my personal life that I did, it seemed like every year, November, December came, me and my husband were scrambling to come up with Christmas money to buy for parents and siblings and kids, and it was a stressful time of year. Last year, starting in January, we both started doing $25 a paycheck to a holiday savings account, and by the end of the year, we had a significant amount of money in the holiday account. Didn't have to scramble at the end of the year, didn't have to pull from our regular paychecks in November, December. We already had planned for that. And I will tell you, it was a stress-free Christmas, not having to make those decisions. So that's one way we did it in our life. If it's any type of goal like that, set just a little bit aside in specific accounts, whether that's you're paid monthly, bi-weekly. I often also get caught spending little small amounts in my day to day because I'm unprepared. Another way of saying I didn't plan. I drive for a living. I visit organizations and schools around the Front Range. So I always try to have water or some sort of drink and snacks in my car, because if I don't, and there's days that I don't plan well, then I get hungry or I get thirsty. I stop at a gas station. I spend $8 to $10 on a drink and a snack, right? Just because I wasn't prepared. Another way that I prepare is the way we kind of help offset lunch cost is we cook a big dinner so that we have leftovers for lunch. And that means that in an emergency and I'm hungry, I don't need to stop for pizza to cover a tight schedule while I'm out driving around. So lots of different ideas of things that you can do. These may be relevant to you or not, but whatever your ideas are in your life, try to make a plan around it. Car down payment is a huge one, which we'll look at on the next slide. If you are going to get a loan, there's some things that will affect the payment, not just the interest. So we talked about the credit score difference between the good and bad credit score, but we're going to look at another example of how you can reduce your expenses by planning ahead, and that's by saving up a down payment. So we're looking at the 720 credit scenario. So same scenario, 720 credit score. They have the 7% interest rate, 60-month auto loan. On the left, you can see the $30,000 loan. So that was getting that loan without a down payment. Now let's say this person prepared, they saved up $5,000 for a down payment. You can see that that dropped the monthly payment by about $100. And for the life of the loan, they saved $6,000 almost in interest just by planning ahead and putting that money down. So again, anytime you can plan ahead for these situations, you're going to save time and money. Go ahead and do next. Insurance is another financial foundation. We're just going to touch on some basics since I'm not an insurance agent, but your insurance needs change over time. Healthcare is often available through work, and that can be helpful to help you in medical emergencies or through preventative programs. You need property insurance, and that will change over time. If you have a vehicle, it needs to be insured, right? You need to be insured to be on the road. Rental insurance is affordable and recommended if you're renting a place. If you buy a home, you're going to need to have insurance coverage. And then there's life insurance, which isn't a big deal when you're young and single, but once you have a family, this type of insurance needs to be considered. So just to think about your insurance needs over time. Also, insurance is one of those things where you want to often assess as well, kind of like you do with interest rates, but to make sure that you're getting the best rates with interest. The insurance companies, another way is through phone companies. That's another one. They don't call you and say, hey, Olivia, we can, save you $30 a month, or for your 6-month premium, we can save you $300. You kind of have to look for those things, but make sure you're always assessing your insurance plans to make sure you're getting the most for your money, and to also make sure that things are covered. Make sure you're looking at the fine print. For example, I live in a townhouse, and insurance is restricting in the way that if, let's say, my structure of my house catches on fire and I need money to cover the things in the house, I'm covered for $30,000, but the fine print says, well, the electronic category will cover me for $1,000. So obviously you have multiple rooms, multiple TVs, multiple computers, cell phone devices, right? That wouldn't cover it. So make sure that if you need to adjust and get higher coverages for specific categories, you're really looking at that fine print as well to make sure that your life is covered in the event of an emergency. And the last thing that we're going to talk about today is retirement planning. So again, for some of you, if you're in your early 20s, it just doesn't seem real and it seems so far away. but we're going to talk about why it's beneficial to start early on. So this example is why you should start considering putting money aside while you're young, and that's through the magic of compound interest, which is when your growth happens on the growth of your original investment. You can see in this example how starting early really has a big difference over time. So this is if you contribute $3,000 annually. So let's say you start at 21, you retire at 65, you're going to have a little under $680,000 when you retire. That's a nice chunk of change. Now, let's say you weren't worried about it in your 20s because you still got 40, 45 years of working. So maybe you start at 35. That drastically drops to 254,000. That's a lot of earning potential for retirement that you're losing. Now, let's say you wait even longer. You start when you're 45. That drops to $120,000. So the earlier you can, the better. It's a lot harder to catch up later in life. What we're seeing right now, like with the baby boomers, is they don't have a life savings, right? They don't have any type of emergency savings. They don't have retirement accounts. They are living paycheck to paycheck on Social Security, which doesn't keep up with the cost of living. So it's really a challenge for people that don't have these retirement accounts and their life savings. And if you guys know anything about Social Security, it was never meant to be sole income when you retire. It was created to be supplemental income, right? Income in addition to your retirement accounts, your savings accounts. So I always like to plug this in early on. And the benefit is most companies will also match you some sort of percentage. So it's more free money. So if your employer offers these retirement accounts, take advantage while you're young and take advantage. Go ahead and go to the next one. So that concludes our financial foundations presentation today. I thank you guys for joining us, especially those of you that are on your lunch hour. It's always a pleasure working with CSU to provide financial education for you guys. I will let you do your conclusion and we'll hang out for a little bit if you guys have any questions to pop into chat.
Awesome. And yes, thank you, Olivia. As she said, if you have any questions, feel free to pop them into the chat if you're watching live. If you're watching this after the fact, feel free to contact us at the Alumni Association or Canvas via this email up here, and we can get your questions answered after the fact as well. But thank you for joining us and joining us over your lunch hour. If you missed something or need to rewatch the recording, just head to the CSU Alumni Association YouTube page, as this will be posted immediately after we conclude the stream today. We'll also be sending you a survey and would greatly appreciate your feedback so we can continue providing programs on relevant topics for you and continue improving our offerings. So thank you in advance for filling that out and keeping an eye out for it. We'll probably stay on for like maybe a couple more, maybe a minute left or so to see if anyone has any questions. But if you don't, feel free to log off, and we hope you have a great rest of your day. Alrighty, the viewer count has gone down, so have a great rest of your day. Again, reach out if you need us, and go Rams!